Well, thanks. Every time I hear that introduction, makes me feel like, yeah, I really don't deserve that. It's actually a pretty good introduction, isn't it? That was done by the radio station here. Anyway, the man said, this is Bill Bullington, and I've got a website up with a seminar coming up, so I'm just going to start off with that. We're going to be, I think it's January 18th, if I'm not mistaken. But let me just double check that when I say that, because it's, yes, it is, January 18th, 6:30, Corporate College East, and should be a lot of fun. I got to tell you, the landscape, the investing landscape, it's really interesting over my lifetime, how different things are. It is mind-boggling. When I think about what we used to do and what we're doing today, it is just, it's been amazing. And the changes are still happening. And as I like to say, nothing is as constant as change in this world. And for a long time, people resisted that. And one of the things I like about younger people is that they have a tendency to embrace the change. And I think that's a good thing, because you're going to have to. It's going to happen whether you want it to or not, actually. So embracing it's a good attitude. And along those lines, we're going to be talking about how the stock market has changed fundamentally over the past, just the past 5 or 6 years. The past 5 or 6 years, the number of exchange-traded funds has exploded. It has literally exploded. It's been the fastest-growing category in financial services. For those of you that don't know, an exchange-traded fund is, we call them ETFs. That's what an exchange-traded fund is. It's a fund that trades during the day like a stock. They typically have very low expenses, and they're designed to do all kinds of things. That's one of the challenges, that there have been so many that come out, and every week there's typically 2 or 3 more. That may have been just within the last 2-3 years that trend has developed, and maybe that'll slow down. But right now there are a couple thousand, a little over a couple thousand actually, and they do just about everything you can think of, and their activity has fundamentally changed the way that stocks behave. Stocks are a little bit more volatile over a short run. Over the long run, it's about the same. But over a shorter time period, they'll tend to go up and down quite a bit more than they used to. Now, there's a benefit to that, and there are 2 ways of trying to take advantage of that. As an investor, you're always looking for something to help you out. And by the way, making the adjustments is not easy. In fact, you're always making the adjustment after the fact, which is kind of what's happening now. To try to catch up to the changes that have occurred, it's opened some opportunities. I can see them now. And we've been, it's been a little bit over a year that we've been trying to incorporate this stuff into the portfolios. But, and it's doing quite well. So from this point on, I shouldn't say that. 5 years from now, I might be saying this again. Maybe it changes. I don't know. This change was relatively easy to see because it started a long time ago in the development of these types of funds. They let you invest a little bit more accurately because you know what you hold inside the fund. It's not that they're necessarily improved. Some of the funds shouldn't exist. Some of the funds have way too much risk. Some of the funds have way too much in carrying costs. Those are expenses that you don't see, that are not in the prospectus. You actually have to be a professional to understand what those are, okay, because they're hidden. And a lot of people don't get that until they see, hey, wait a minute, this is made like 15%, which is a big number, 15% less than this. And I thought I was investing in the thing that, the second thing, but this. And what I got was 15% less. Or I was right, I picked the right fund. The market moved right in the direction that I thought it would, and that fund didn't participate nearly as much. So that kind of stuff happens all the time. Those types of ETFs, by the way, are not very productive. They exist because people are in love with the idea of what the fund does, never mind the fact that you can't actually execute that. That's tough. So in some ways it's really helped. It's helped people like me And I think it's really probably hurt the everyday investor because there's just too much to read and not enough time to keep up with all this stuff. And in fact, most of the people that do what I do for a living don't really keep up with it. They rely on their firms to keep up with it for them. And oftentimes their firms may not have the same agenda in mind for you as they do for themselves. And that happens a lot. And that's, not good or bad. That's what they feel like they have to do. May not be the same, may not be the best thing for you always. And that's one of the things that I guess if I were talking to an advisor, I'd want to know, how do you get paid? Because we're fee only. So if the assets drop in value, I get a pay cut. Whose side do you think I'm on? I mean, really. So if I do something and it turns out not so good, it's not because I was trying to do poorly or because I was influenced by how much I was going to get paid. It doesn't matter. It doesn't matter what I do. So that would be one of the first things I guess I would ask. The other thing is, can you explain your strategy relatively simply? We're talking about ETFs. We've got this seminar coming up. There are opportunities that presents that are relatively unique to this particular time period in our lives, in everybody's life. These changes have brought about some opportunities. I think if you can get your arms around it, it'll allow you to operate with a little more comfort psychologically, and that's an important thing, to be comfortable with what you're doing, to kind of understand better the risk that you're taking, allows you to deal with it on a more improved basis, I guess, for lack of a better phrase. But anybody that's comfortable and understands has a tendency not to get rattled, when the market drops. That's what we're really talking about. What do you do when the market drops? If you really don't know why you're doing what you're doing, then it's going to be hard to stick it out. If you don't know why you're doing what you're doing to begin with, and then market drops, that's why the average investor has a very hard time achieving the results that they should be achieving. And I go through it. We all go through it. The number one problem that people have, by the way, we'll come back to that a little bit later in today's program, but there's a problem that everybody has, and it comes from lack of knowledge, not lack of stamina or lack of assets. It comes from lack of knowledge. The number one mistake that average investor and professional investors make is a lack of knowledge. And I know that sounds kind of strange, a professional investor with a lack of knowledge. Let me tell you something. I see it all the time. My business, I see it all the time. There are people who memorize the answers to test questions to pass their exams, even get their PhDs. Most PhDs have to be able to write, by the way. But that doesn't mean that they actually really understand the material, or that they have the emotional and psychological outlook necessary to succeed in financial markets. Because those of you that understand what I'm talking about are nodding your heads right now. Now, a lot of you are going, what the heck is he talking about? All right, well, if that's you, you need to get to the seminar. That's kind of a big deal. It's preparing yourself for what you're going to see, setting realistic expectations with yourself and of your financial advisors. Got to be realistic. What is realistic? Realistic is things based on what might have happened in the past. You don't project that onto the future just the way it happened in the past, because it's not going to repeat itself. But then you start taking around and looking at some of the things that are coming up in your economy. Where have we seen those before? What was the result of that? Why does it work that way? Causation, not correlation. That's a big one. That's a big idea to try to get hold of. Understanding that doing the right thing is not always the most profitable thing. In many cases, doing the right things will lead you to underperform for a while. In fact, anybody that hasn't been in large cap over the past 5 years has probably underperformed, probably by a lot. But if you held all the other asset classes because that's the prudent thing to do, it's been costing you money. Now, the alternative is to get a crystal ball that works and know when to shift that money around. That's the alternative, one of the alternatives. Okay. Another alternative is to do the right thing, hold the other asset classes, rebalance your portfolios, which means you would have been taking money out of the best performing categories, by the way, and adding to the ones that were underperforming. And up until this year, adding to the emerging markets, you'd have been kicking yourself. Oh man, those things were, they were not doing well. Well, this year you're going, aha, and that's why we're doing it. It's like I said, you got to have a long-term outlook. You got to know what you're doing. You got to have a lot of knowledge. Looking up the past performance and expense ratios it's a start, but it's not a good one. I mean, you're barely out of the blocks doing that. We're going to talk about why all that stuff's actually how it's available, how you can look into those things, how you can find out what you really own. And I will tell you something that the Investment Company Institute, who tracks a lot of investor behavior and formation of mutual funds, ETFs, pensions. There's another institution out there, Dalbar. They study investor behavior. They're just studying what the investors have done and not why. They're just looking at what they've done and not asking the questions why. Why? Because that would be incredibly expensive to do. I mean, incredibly expensive. To try to take a poll of every individual investor across the country, good luck. Especially since they're not required to. And so these guys come up with data. This is what happened. I'm looking into why it's happening. And I can tell you that over the past 30 years, the average investor chases performance. That's not anything new. The Dalbar studies show that. They look at the things that have just gone up the most. Most people don't even realize that that's what they're doing. Most people don't realize that when you pick 10 different mutual funds that all have good track records and you're looking at solely the performance, most of those mutual funds are going to be holding the same stock, so you'd be better off just holding one. You don't have 10 different 1099s each year that you have to deal with. So, yeah, there's when you start digging into it, it's still pretty simple. But those simple ideas are not easy to come by. Nobody's publishing those. Not until this year when Bullington Capital is going to I'm going to publish those. I'm going to tell people what they're doing and why, and how to identify those mistakes, those behaviors that are causing the same errors to happen again and again. And let me tell you something. Doing the right thing is not easy. It's not easy because what you want to do and what you should be doing are typically not the same thing. Now, not always, because, if you are super sophisticated, you're one of these consultants and deals with multi-billion-dollar pension plans, you probably know. In fact, I know you do because I see your performance and I see how you invest. So if you've got billions of dollars to invest and you can afford to hire one of these guys, you should probably do that because they do a very good job. That's what we're doing. That's what we're trying to do. And that's what we'll be talking about at the workshop. It has opened up. The fact that more people have moved to this, the fact that a large percentage of the smaller institutional investors, like the companies that maybe have a couple million to 4 or 5 million, are now getting access to the same tools that the multi-billion-dollar funds had. That's where a lot of the growth in these industries is coming from, and it's caused some unintended side effects that can help you. There are some side effects to what's going on that you can gain from, and that's what we're going to be talking about. Again, that's January 18th, Corporate College East, 6:30. Go to my website, bullingtoncapital.com. There's no cost to attend. Seating is limited, but there is no cost to attend, and it's going to be fun. And by the way, I love the facility out there, the Corporate College. Great facility. Seating is awesome. They've got a couple 5-star chefs that work there now. And so when they do their refreshments and all that, it's top notch. So hats off to those guys. They've really done a good job there. And as always, you could always call us if you don't have a computer. You can contact us 330-664-0700 and sign up that way. So, and if you have any questions about anything you hear here on this show, feel free to drop me an email. I'll respond as quickly as I can. I will tell you that the end of the year for us is one of the busiest times of year. Everybody's looking, a lot of people are talking to their accountants and they're looking over portfolios. Hey, should I make any tax moves? So we are really busy, but we will get back to you. First quarter tends to be pretty busy too. People are trying to gather all the information they need to get their taxes done. A lot of times they're calling. One of the things that we do at Bullington Capital, we can set up a secure website for you. We do it all the time. There's a company called ShareFile. And it's all military-grade encryption. You've got a document that you need really fast. We can upload it to that, send you an email. You set up a password user ID. You can go in securely and download that document. It's at least as secure as putting it in the mail is. So that's one thing we would do for our clients as well. So if you have any questions regarding that, if you're a client and you're listening and I got to get some documentation, feel free. That's what we do. The only reason that comes to my mind right now is because we've been doing it so much, given that this is the end of the year and a lot of people are doing year-end planning. So kind of interesting there. A little bit later in today's show, we're going to talk about the individual stocks. The last segment of each show, I like to talk about individual stocks, particularly with some of the information that's become available now and what we're talking about at the seminar that I talked about. There are some changes that have occurred. The overall structure of the stock market's a little bit different than it has been in the past, and it's been evolving. It's not like it just switched overnight, but now the momentum has really kind of picked up, and it's opened some opportunities. And I think that you might want to take advantage of that. These are the types of things that I'm doing in some client accounts. I'm working on ways of rolling this out to multiple client accounts if they want to participate in something like this. But now that I hear the music, I'm going to have to wait until this commercial break is over to tell you more about it. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned. And we're back. Listen, if you'd like to call, you have a question, comment, 216-901-0945, 216-901-0945, and I'd be glad to take questions. I just wanted, to talk a little bit, too. I was reminded of this during the commercial break. There was a gentleman that was listening to this show last week. We had Mike Razor. He's an attorney with a Cavich Familia. It's a local law firm. He was on the radio here to talk about a couple different things. And somehow, what we were saying, someone had anticipated a direction that we were going into in the show, and it was not that way. It was actually the opposite, quite frankly. He thought that we were going to advocate cutting Social Security. I would never do that, by the way. That is I have no idea how that how that idea came from this show. The Social Security is something you earn over your lifetime. It's a great program. I would not advocate anybody ever touching Social Security. So just wanted to get that out there. Not sure how that was interpreted that way, but that is, I can assure you that we do not believe that you should cut Social Security. So it's a lifeline to an awful lot of people. So I think it's a great program. It's a super program. Anyway, so I had to get that off my chest, and hopefully that listener tunes back in, because I hate to see somebody go away thinking that we were going to say something that we weren't. But anyway, doesn't really matter. And if you have questions, comments, feel free. You can go to my website, and you can take that in. There's a contact us form there. Fill it out, and we can call you back or talk to you about whatever it is that you have on your mind financially. So that happens quite a bit, quite frankly. And another thing I was planning on doing this year is trying to put out some relatively simple articles, because investing and retirement planning, they're actually relatively simple. They can be, or they can be as complicated as you would like to make them. So it can be simple or it can be complicated. And it's really up to you, the individual. I know there are an awful lot of people in my industry that are kind of attracted to the industry because they're the really detail-oriented type where, a lot of accountants, CPAs, engineers, that kind of thing. There's so much data there. Those guys are in heaven. They just love that sort of thing. But, although I understand that material and I understand the need to want to try and do that, I think realistically, there's only it can be made much simpler. And I think many more people fit into that category and could be a lot more successful if they were being introduced to or working with somebody that did the same sort of thing. Now, not that there's anything wrong with trying to get down into the nitty-gritty details, but sometimes it's counterproductive. Can actually lead to indecisions or decisions that take too long. Because I got to tell you, the market moves relatively quickly. You need to know what to do ahead of time, not try to figure out, when you get there, because there are a lot of things that you're going to have to weigh and measure. And but anyway, as an example, let's say you're doing retirement planning. I'm going to do some retirement planning. I want to get just a rough idea of where I think I'll be. What do I need to do? Well, first thing you need to do is figure out what your sources of income are going to be. Are you going to have Social Security? Are you going to have a pension? Are you going to have a business that you continue to run? That's a hard one, by the way, because if you're a business owner, you already know how difficult that is to try to guesstimate what you think your business is going to do year over year. Sometimes it's the toss of a coin. Isn't it amazing how your mind works? I just put the wrong letter in front of the wrong word. But anyway, so that can be a little bit more difficult. The vast majority of people, you've got sources of income, whether it's Social Security or pension, and you have savings. Okay, that's what you have to work with. So you really don't have to worry too much about that. That's about how much you think you might get. Now you're going to have to make some assumptions on what kind of returns you think you might get. And basically you're coming up with an estimate. That's what you're trying to do. Come up with a decent estimate of what kind of returns you think you can get. Knowing that unless you lock up all the money in CDs, that it's just an estimate. But you're going to use, history. You're going to use if you go back and you look at economies that are similar to what they are now, they're never going to be the same because things are always changing. But when you look at conditions, like right now, GDP growth is inching up. They're talking about cutting taxes. They're talking about, and interest rates are fairly low. So if you go back through history and you look at other time periods when the economic conditions were similar to what they are now, it can give you an idea, just maybe a slightly better estimate of what you might be able to expect. And I will tell you that there hasn't been one that's exactly identical. In fact, they say history repeats itself. Well, it does, but not exactly. So there are a few things that are a little bit different about this one. But bottom line is, if you use a long enough time period, if you look at the valuations on stocks, which incidentally are skewed right now. You look at what stocks are selling for versus what they should be selling for, then they're slightly ahead of themselves. If you look at the S&P 500, some of the other categories are under where they should be. And that's very important, particularly now, because those other categories have started to catch up. They're closing the gap in the long run. They typically happen to be, they're typically 1% to 2% from each other. So they're very close. If you look over, say, 20 or 30-year rolling time periods. So what's a rolling time period? Well, that would be 1930, and a 20-year rolling time period would be 1950. That's 20 years. Then it would be 1931 through 1951. So that's another 30 years. Or I'm sorry, 20 years. You go 33 through 53. That's what I'm talking about, rolling. Okay, there's a 20-year time period, but each year it's a different 20 years. You go back and you look at those sort of things, and you find a few that have very similar characteristics to the ones that we have now. And it's better than doing nothing, I should say. It's better than doing nothing. Give you a decent idea. I'll tell you that when I look at how things are actually going right now, I think it's very positive. I think it's a very positive thing. I think that is there risk? Yep. Is it super high risk? Nope. It's not like the year 2000. And the risk isn't like 2007 when, all those bad mortgages that they were selling in the early 2000s actually started falling apart. That was rough. That was really rough. Right now, we don't see a lot of stuff like that. And if you look at the bank loans that are going bad, doesn't look too bad. Actually, it looks pretty good. You look around and things look pretty good. Now, having said that, last 5 years, large company stocks have done better than just about everything. Large cap U.S. stocks have outperformed just about everything on the planet. So unless you knew to invest exclusively in the S&P 100, the S&P 500, put all your money in those things and then just capped it, okay, you probably haven't made as much money as those people that did that. And I will tell you, those people did that on luck. That was not skill. They guessed and they got it right. And but I can also tell you that those other categories, the small cap, the mid cap, the international emerging markets, those things that hadn't done quite as well have started to catch up and close that gap now. And I think there's still time. I think that probably this will be one of the longest bull markets in the history of the country. Now, that's not saying as much as it sounds like. Yeah, when I say that, you have to take into account where we were coming from. We're coming from a major crash, one the likes of which we've only seen that 4 or 5 other times in the last 100 years. So yeah, when you're comparing it, when you throw that little factoid in there, you're like, oh, well, yeah, it's not crazy, not yet anyway. Some large caps, some large company stocks are selling slightly ahead of where they should, and I think the S&P is probably slightly ahead of where it should. Not a tremendous amount, with interest rates as low as they are, probably not going up anytime or drastically anytime real soon. I'd say you want to hold in fixed income that's short-term in nature. The short-term interest rates staying relatively low, longer-term interest rates staying relatively low. There's a kind of a flat yield curve. That's if that doesn't mean anything to you, don't worry about it. It's a little concerning for some people, but I think you have to go back and look at the causation, not the correlation. And a strong underlying economy is a good thing. So I think we'll be reasonably well rewarded over the next 5 years if you're looking out that far with your investments. If you're looking out shorter than that, yeah, I hate saying this, but you probably want to increase or rebalance to international emerging markets. Pick some good funds, ETFs out there. That's what we do. That's what we're looking at. They have done better than the other ones this year, but like I said, they've underperformed for quite a while. There's still opportunity there, though. I really believe that. Barring some sort of a major worldwide catastrophe, which you can't ever really anticipate. So it's not really worth it to try to do that. But I think right now you want to be looking at international emerging market for some portion of your portfolio. If you've already got it, great. I think small, mid cap, large cap, the vast majority of people right now, when they're calling, they're looking at the S&P 500 and the Dow. Those are huge stocks. Those are gigantic. Those will have a tendency, and they're not undervalued anymore. In fact, they're slightly ahead of where they should be. That doesn't mean they can't or won't go higher. That happens all the time. That's what's so confounding about stocks in the stock market. Stocks will do things that they shouldn't do for fairly long time periods. It's amazing how that works. They'll do things that they shouldn't be doing for fairly long time periods. And oftentimes it's long enough to convince the average investor that it's going to stay that way. Actually, I've seen it convince professional investors that it would stay that way, right when it doesn't. So it's kind of hard, when you're looking at history, you have to really study hard. And again, I think there are lots of opportunities. By the way, one of the things I did want to talk about too was where to go for fixed income right now. Right now, I would not be holding long-term bonds. And thanks to one of my clients for bringing this up to me. I told him I was going to talk about it this Saturday, and I am. So this is what we're doing. we're looking at fixed income. I think if you're looking at putting money in fixed income, that's investment money, that's not money you need for your emergency fund. If you're going to do that, okay, then you need to you might want to look at mortgage-backed securities that are seasoned. Now, actually, you want to look at funds that invest in mortgage-backed securities that are seasoned. What does that mean? Those mortgages that have been around for 25 years only have 5 years left on them. Okay, the principal is coming back in those every month. Every month, a large chunk of principal is coming back in. So as interest rates begin to rise, as the short-term interest rates begin to rise, you're reinvesting, or the fund manager is reinvesting a large portion of that principal in the newer, higher interest rates. And I would suggest that you want an exchange-traded fund that's actively managed, quite frankly, especially in that particular space. That means that a computer program is not going to run the portfolio. That you're going to have, the computer's going to do a lot of the work. It does a lot of the screening work, but then the professional comes in and says, okay, these are the ones we're going to take, and we're going to make some adjustments, and is actively managing a portion of the decision-making process. So I think that's, and in fact, a lot of scientific research now has come back to say, yeah, artificial intelligence is not the be-all, end-all. The better results have been a tendency to come from computers assisting people. So you can Google that if you don't believe it. There are lots of articles on that. And that's the kind of thing that I like. It makes sense to me. It makes common sense. When you're looking at a mortgage that's only got 5 years left on it, what are the chances that they're not going to pay that off? Somebody that's been paying for 25 years and then they're 5 years into. Now, if something happened, somebody died or somebody got, disabled, yes, that's going to happen occasionally. But the vast majority of those, they're going to try to make their payments. They're so close to having their future paid off. What's good for the investors is that, first of all, those interest rates on those mortgage-backed securities are slightly higher than treasuries or CDs. And there's a big chunk of principal coming back every month so that as interest rates rise, they can reinvest at higher interest rates. Now, in the meantime, the prices of those funds is going to fluctuate. The price of the fund, is particularly in a fund like that, can actually perform worse than the underlying assets would. That's a hard thing to get your arms around. That is really tough, particularly when all you have to look at home is the closing price of the fund. And that's one of those situations where it really pays to know who the fund managers are and be able to get on the phone and have them answer questions for you. And, basically, I'm pretty blunt, by the way, when I talk to them. Hey, what's going on? And what do you think? And if I don't hear the right answers, I'm looking for another fund, because that is and generally, by the way, I've done so much research before I even invest in a fund like that more often than not, the right answer is coming up, and more often than not, it's the market prices, which tend to get separated from market values. And if they didn't, incidentally, there would be no point in having a money management industry. Everything would always reflect accurately like it was supposed to, and there would never be any opportunities. Anyway, I hear the music. That means I got to take a real quick commercial break. This is Bill Bullington. I'm on 1420 AM. I'll be right back. And we're back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon, 1420 AM. In this part of the program, we're going to focus a little bit on some individual stocks. A lot of people like to talk about it. A lot of people like to know a lot about it if they can. And let's see here. I'm just going through one of the scans I like to do. And this is what I do for a portion of the money I run at Bullington Capital, a very small portion of it. It's actually how I do a small portion of a fund that I run. So what I look for are stocks that are moving up quickly right now that may be undervalued. And that's what or at least they're not grossly overvalued. So I'm looking for a combination of fundamental items. Fundamentals are things like sales growth, the company's valuation. That's a fundamental item. Valuation, for those of you that don't know, is just basically what is this stock selling for today, and how does that compare with how much a stock like that would normally sell for. It's what I really like is when you get a stock that's underpriced, that's going up fast. Now the odds are, they just shifted in your favor a little bit. Not 100%, by the way, and that's, we'll be talking about that I do this at every seminar. So if you want to come, we'll talk at least 15 minutes about this because I think it's interesting. I think it's really interesting. I really like doing it. Been doing it for a very long time, and it's fun. So anyway, feel free to call too, 216-901-0945 if you have questions regarding this. But here's one of my favorite scans as I look at every stock in the United States that has a capitalization that's above 300 million. Okay, I used to use 250 million, but the SEC put out some restrictions on mutual funds to be able to invest in those types of companies. So not a lot of them do. That's either good or bad, but the reason that I restrict it to 300 million is I want this company to be eligible for inclusion in a stock index or a fund. I'd like a fund to be able to buy that stock. And now that I just said all this stuff, okay, my computer just took a timeout on me. I got it back. So I'm going to start by looking at companies who can be purchased or are being purchased in mutual funds and exchange traded funds. Now, this company called Telechart that I use, they're not paying me for this, by the way, but they've got some really cool features. And it'll actually show you which funds now hold the stocks that come up on your scans. Or if you just pull up a symbol, you can actually see which funds are which funds or ETFs are holding that stock. Like here's one that came up just on Friday, R. Donnelley and Sons. And many of you may recognize those. I've talked to a couple of people that have actually owned that stock. The stock was down quite a bit over the last year. It was down about 50%. Now, on a 1 month basis, looks like the trend is back up again. It just broke through a long-term downward trend line. If you connect the last three peaks, one that occurred in October, one that occurred in July, and one that occurred in March, it's just breaking right above that, and just barely, by the way. So it comes up on a scan because it's moving up fast over the past 30 days. It's up 3% in a day. It closes in the top 25% of that day's range, and the volume is above its average daily volume. All that criteria. That met all that criteria. Does that mean that stock is a surefire winner and it's going to go? No way. It does not mean that by any stretch of the imagination. What it means is that over the last month, it's been doing pretty well. And on Friday, it exhibited characteristics common to companies that are being accumulated. So that's what it means. That's all it means. And I look at the valuation on a company, and it's extremely low. And I think, oh, well, if I had, some spare cash, which at this moment I don't, because I'm fully invested, I would probably take a look at that. There's no doubt in my mind that I would take a look at that. If one of the stocks that I'm holding now gets stopped out, and I do have cash, and then it comes back up on the scan the day that I have cash, I'd probably take a look at that. In fact, I'd probably take a shot at that one. Although I'm not really fond of investing in companies that are under $10, but this one's like $9.21. I'm not that super fond of it, but here's my point. And this is one of the things we're going to be talking about in detail at this seminar, because this has fundamentally changed the way that stocks are behaving. Okay, so when that stock was in a downtrend, when you look at it, it actually looks pretty orderly. The downward trend looks orderly. What do I mean by that? I mean that volume starts to pick up as the share price is dropping. When the share price rebounds, the volume tends to die down a little bit. And then as the volume starts to pick up again, this share price is dropping again. So the share price and the volume are moving kind of in lockstep. And this was actually one day on Friday was a day where that kind of has reversed. And it looks like a classic reversal pattern. It's broken the downward trend. Now, will it continue? We don't know that. Nobody knows that. Yeah, but I can tell you this, okay? It's part of, I'm just looking at the number of exchange-traded funds that this one is a part of, and it's a part of a large number of exchange-traded funds. And again, we're going to go through this at the seminar in detail. I'm going to show you what I'm looking at the seminar. The things that I'm reading off to you right now, you'll be able to see that. Okay? So it's in a ton of exchange-traded funds, and the vast majority of them are market cap weighted. So the vast majority of these are market cap weighted funds, and the it's kind of interesting. A market cap weighted fund has to buy stocks that when they go up in price, they have to continue to buy them. Just what they do. When the share price is going down, they have to sell them. Now it's a very complicated thing because they don't have to do it every day, each day. Every fund's slightly different. Some of the weightings in the fund are different, but it does give you some idea of what might actually be happening there, and I think it's a good thing. Anyway, I have to take a real quick call right now. I got Jerry. Jerry, how you doing? I can't hear Jerry.
Yes, sir. I'm here.
Oh, that's we had to get you tuned up in the shop here.
Okay. Well, I'm calling about R.R. Donnelley. I'd like to pontificate a little about that because I know something about the industry. Mm-hmm. Okay. R.R. Donnelley was started as a printer. Now it's gone into a media company, but it's a terrible industry.
Right.
I mean, if you look at the magazines they used to print, back 10 years ago, they could be a quarter to a half-inch thick. Today, they're a sliver what they used to be. The advertising revenue is nothing like it used to be.
Right.
And I really would be kind of leery about going into that stock itself, unless it's and I don't have the numbers in front of me, but unless it was at an extreme discount.
On a fundamental basis, that's what you're talking about right now. You're talking about all fundamentals. Okay, I agree completely. The only reason I was talking about it was the first stock that came up in the scan.
Okay. Well, I'm just wondering if there aren't better candidates out there.
Well, what you're trying to do is you're actually looking at this as an investor,
as opposed to a trader.
Well, yeah, or trend follower. And what I'm my point is that, and this is something that we're going to talk about at the seminar, and I think it'll be much clearer at the seminar because of all the stuff that I can show you visually. And when you're looking out, when you're doing trend following, the time periods have shrunken up big time. And a stock, we were talking about this a few weeks ago, that AAOI. It did extremely well. Then it started dumping, and then it went down quite a bit. The buy and hold investors are still, depending on when they bought it, probably still have some sort of a profit in it if they didn't, buy it recently. And my point to that whole part is this is a particular style of investing, and you do not have to do what you're doing. You don't have to look at the fundamentals. If you want to be a long-term investor who's going to put up with the 40-50% average annual ranges of average, then that's the kind of stuff that you want to look at.
Okay. Let me give you something else here, just out of curiosity. I think you're going to say I was crazy to do it, but I can accept the criticism because I know it's well founded. But we'll say R.R. Donnelley could be I don't know if you call it a momentum stock or a trend stock, or they're kind of related, correct?
Yeah, typically they're one of the same.
6 of one, half dozen of another. Yeah. Okay. I originally got into AAOI along with a couple other stocks because they had a lot of momentum going in with them. Rather than investing in the stocks, I would sell puts against them. In other words, I would be on the side that they're going up. I'm going to take something that the stock is not going to go down. They're going up rapidly.
Well, see, and the only reason I don't like doing that is you're paying a premium for the time. So not only do you have to be correct on the direction, but you have to get it within a certain time period.
No, Bill, what I'm saying, though, is I'm a seller of the puts, not a buyer.
Right.
I'm a seller, so I'm taking the contrarian point that
it's not
the
going
stock,
down. Right.
Exactly. It's not going to go down. It's going to continue going up. So, no, when I do options, I very, very rarely will take a long position for the exact reason you said, that I will take the position that I let time decay do my business, my work for me.
Yeah, well, if you've got nothing else to do, I would say, yeah, that's pretty good. Or if you just keep it, I know you're keeping this small. You're not doing this with 80% of your money. So, yeah, and then that's fine. But, hey, Jerry, we ran out of time. I can't believe it. Thanks for calling. We'll continue this next week if you'd like to. But thanks for calling. Thanks for listening, everybody. This is Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420. The Answer. I'll see you next week. Have a good week, good investing, and good luck.
Report. Broadcasting every Saturday at 11 a.m. on AM 1420. The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.
Have you racked up more than $10,000 in credit card debt? Are you barely getting by, making minimum payments? You should know the credit card companies are tricking you into thinking there's no way out. Credit card companies would rather you didn't know that there are ways you can become debt-free and you don't have to pay the entire amount you owe. There are debt relief programs that help people like you escape overwhelming credit card debt. National Debt Relief has helped tens of thousands of people just like you reduce more than $500 million of debt. National Debt Relief has helped so many people they're A+ rated by the Better Business Bureau. You don't have to declare bankruptcy or take out a consolidation loan. You have the right to settle your debt for a mere fraction of what you owe. Reduce a large portion of your debt now. Call National Debt Relief at 800-694-7394. 800-694-7394. That's 800-694-7394.
Thinking about life insurance? What if you could make one free phone call and learn your best price from nearly a dozen highly rated, price-competitive companies? Well, that's exactly what happens when you call SelectQuote Life. For example, George is 40. He was getting sky-high quotes from other companies because he takes meds to control his blood pressure. But when I shopped around, I found him a 10-year, $500,000 policy for under $25 a month. I'm SelectQuote agent Dan Savino. And believe me, if SelectQuote isn't shopping for your life insurance, you're probably paying too much.
For your free quote, call 800-721-4880. That's 800-721-4880. 800-721-4880. Or go to SelectQuote.com. Since 1985, we shop, you save.
Get full details on the example policy at SelectQuote.com/commercials. Or price could vary depending on your health, issuing company, and other factors. Not available in all states.
Is negative content or comments on the web affecting your personal or professional reputation? Unfavorable comments, embarrassing pictures, videos, legal documents, and bad tweets can ruin your personal life, your career, or your business. Reputation.com can protect your good name. It's easy to squash the unfair attacks with our patented system. Call right now for a free expert reputation analysis. Call 800-651-4888. 800-651-4888.
Hey folks, tune in this Sunday at 3 p.m. for the Brian Williams Radio Hour. This week I'll interview Dr. Green, author of the book Mr. Chairman, The Life and Times of Ray C. Bliss.